Hello and welcome back to Kitco Mining's Digging Deep, sponsored by Revival Gold, with me, Paul Harris, in which we talk about this week's mining and exploration news. Joining me today is Nicole Adshead-Bell, Principal of Cupel Advisory. Nicole, welcome back to Kitco.
Thank you very much again for having me, Paul.
Now, Kitco, you're in Europe. You've just been at the Precious Metals Summit in Zurich. How was that?
Actually, it was really good. It was quite a sea change from last year. Now, Zurich tends to be the dominant investor makeup is high net worths and family offices. And so I was there representing Hot Chili, and we had back-to-back meetings both days, a lot of interest, and it was great to see this expanded base of resource investors. So it was really, really good, useful.
I missed being there, but unfortunately I was on a site visit. Well, not unfortunately, I was on a site visit with our sponsor to visit their Mercer project in Utah. Now, the report card for the 3 months to September 30th, the results are in, and overall, I think investors feel gold companies should have done better, given the surging metal prices. Few companies excelled, several missed guidance, and working capital is becoming an issue for others. While some companies did produce record earnings and free cash flow, investors' attention was grabbed by the continued increase of all-in sustaining costs, which meant muted margin growth. All senior producers saw the all-in sustaining costs increase over the same period of 2023. However, Kinross Gold and Pan American Silver reduced theirs from the June quarter, while another three saw less than 2% gains. However, there are some shocking all-in sustaining cost blowouts, including from B2Gold, whose AISC ballooned 30% and came with a $636 million non-cash write-down chaser. And the ounces produced by SSR Mining, Calibre Mining, Centerra Gold, Alamos Gold and Equinox Gold were much more expensive than those produced a year ago. Thank heavens for Orla Mining, which reported an all-in sustaining cost of $720 per ounce. Nicole, what has happened with costs? This seems to be something going beyond wage and fuel inflation.
I do think that we're still in an inflationary environment. Frankly speaking, when we had this discussion, I think it was before the quarterly results came out, I was feeling that they had stabilized somewhat, but you have got productivity issues when you speak to companies. I think not just in mining, you've seen anecdotally, and a friend of mine is renovating a house, and the costs of that have increased substantially, even though supposedly inflation is going down. So I think you're still seeing this impact with the global supply chains, that's being pushed through the system. I do think to better understand the AISC number, that's an ounce number. So to truly understand a company's management of its business on a cost basis, you need to dig in and look at the unit costs. So that's the per ton costs. So to understand, are they per ton costs changing dramatically, or is the AISC increase a function of grade changes? And what you do tend to see happen when underlying commodity prices go up is a greater willingness to mine some of the lower grade parts of your ore body, which results in an increased AISC cost.
I think I was crunching the numbers this morning, Nicole, and one thing that stands out this year, every quarter this year so far, the intermediates on average have had a lower all-in sustaining cost than the major miners, the tier one companies, which would be surprising to me because presumably they've got lots of tier one assets and the intermediates do not.
No, when you see, it's one of the reasons why the majors will offload the smaller underperforming assets is mid-tiers, just from the nature of the beast, and I don't think it always has to be this way, but often the larger company becomes, the more it becomes about process than productivity. So if you're a smaller company, I think it's you tend to see those companies have got a greater focus on their individual assets because they're smaller and they have less assets. And so I sometimes think that the smaller companies will tend to be managing their businesses more aggressively because they don't have all of those things that come with size that the majors have in terms of probably balance sheet and other types of heft.
Well, I think a really, really good example of that is a company we've mentioned already, which is Orla Mining. They picked up their asset, Camino Rojo in Mexico, from a major miner, and they're doing great guns there, $720 per ounce. Another observation of potential concern is that for the intermediate companies, Allied Gold, Calibri Mining, Iron Gold, and Equinox Gold had negative working capital in the quarter, with the fourth, Torex Gold, barely in positive territory. All are or have been until recently building mines. Nicole, how much of a concern is negative working capital?
It's a very, very big concern if the underlying commodity price is in a declining environment. So it's debt is what kills you as an operator, and we've seen that time and time again. We've got numerous examples on the smaller scale with Pure Gold going bankrupt and some other examples. And from my perspective, the leading indicators of that is when you start seeing working capital go into the negative, you start seeing a build up in payables. You see burning through cash, negative cash flow. And again, you'd just want to spend time and go and look at those individual companies' balance sheets and coming out of a big spend. And if they are transparent about in talking about their companies and in their financial statements and in their MD&As, it does make sense when you're coming out of a big spend. Obviously, your balance sheet has been impacted by that. And then you should start to see the balance sheet improve. What you really need to focus on is the downward trend, the negative trend. And if you start seeing quarter after quarter where it's negative cash flow, the balance sheet is looking, and it's very, very easy numbers to track, where the balance sheet is looking worse and worse, that's a very, very bad sign.
I think one thing that stood out for me, since I've been tracking numbers, which is basically since 2019, it's the first quarter where there's been more than one company with negative working capital. Yeah, go on. Sorry.
No. Sorry, I didn't mean to. I'm a good interrupter. What can I say? No, I agree. It's kind of it. I think what it is too is we've had now in excess of a year of rising commodity prices. And in a rising commodity price environment, everybody feels better. They feel better about their business. They feel more willing to make higher risk decisions. And whether that's in capital deployment or things that impact AISC, so mining, lower grade ounces. So all of that can kind of come to a head at the same time. And there are trends in our sector. And so I think what we're seeing is a culmination of a number of companies that are ending big spends. Hopefully that will reverse, and also that comfort that comes with being in a rising commodity price environment. And obviously, we've had a bit of a shock in the last week or so.
Now, let's extrapolate that into a broader conversation about capital allocation strategies. Looking at the data from the quarter, gold producers continue to focus on returns to shareholders as another 800 million, more or less, was returned to take the total for the year to over $4 billion. The precious metal sector is still carrying about $23 billion of debt, with only a few companies paying down more than $100 million during the quarter. Nicole, is the preference for shareholder returns over repaying debt a concern?
Yes, absolutely. I think that at the end of the day, most investors are not owning gold stocks in particular for dividend payments. They are owning them because it's a cyclical industry, that you have the underlying torque to the commodity price. So an overemphasis on shareholder returns in the form of both dividends and share buybacks, I think that they can have short-term positive impacts on share price. I think it's quite hard to assess the long-term impacts. And at the end of the day, you need to have a business that is in a volatile commodity price. You can have short-term massive swings in the underlying commodity price. It's how do you ensure that you have enough financial strength to deal with the bad times as well. And so I think you always want to see companies that have a degree of conservatism around their balance sheet. Ironically, in a very strongly trending commodity price environment, which is what we've had, the companies that have the worst balance sheets and the worst cost profiles tend to outperform those companies that have the good balance sheets and the good cost profiles, because they have much, much greater leverage to the gold price. And so they'll outperform on the upside, but on the flip side, they'll underperform on the downside.
So I guess investors are faced with a choice of financial prudence and boring, and financial not so prudent and quite exciting.
Well, no, exactly. And really what you want to see is companies, when they are overvalued and when their paper is overvalued, that they they leverage off that, so that they use their paper either via the issuance of equity. If you're overvalued, one of the most accretive things that you can do is issue equity, or that they acquire something else and maybe increase the quality of their portfolio. So I think it behooves companies to be constantly, as objectively as possible, assessing their relative value and being honest with themselves about what their value is.
When you look at the 5-year charts of a couple of companies, Barrick Gold and I think it was Centerra, the 5-year charts look really bad. So buying back their shares is perhaps a good thing at this moment in time.
Yes, Centerra, its biggest negative, a very, very strong balance sheet, but it lacks growth. And we have been in an upward rising commodity price environment where you get rewarded for growth. So, and Barrick, to some degree, the same thing, because Barrick has very, very clearly messaged that they are not going to pay a premium for anything, which means smaller companies almost always get taken out for a premium. Now, no premium like for like mergers, that absolutely makes sense, but you're essentially telling all of the potential targets that you're not going to pay a premium, and so why would they engage with you? So arguably Barrick's strategy in this gold price environment is also somewhat ex-growth, and the biggest growth project is one that's in a very, very high-risk jurisdiction in Tajikistan.
When I speak with gold companies, a lot of them say that they're comfortable with their debt because it's relatively low priced and it's going out 5-10 years. It does seem, though, that creates a feeling that it's much like Western governments. Debt will be a problem for the next CEO to solve.
Yes, and I think all of us culturally, and I've seen it in, I suppose, in my lifetime, when I was 20, there was no way I could get a credit card. No credit company would ever give a 20-year-old a credit card, and that's very, very different today. And so not only have we on an individual level become more comfortable with debt rather than saving for that thing that we want, we deserve it today so we can live our best lives, all of that rhetoric. But companies have become comfortable with it, as have governments. And at some time someone has to pay for that. So if you're a CEO, it's like the commitments for net zero in the next 20 years. Everybody's very happy to make these commitments that they will never be able to meet, but they're not the ones at the end of the day that will be holding the card and taking the fall for that. So I do think we live, and that comfort with debt was really driven by being in a almost zero interest rate world. That's why we had such the big shock with inflation, with debt, with interest rates increasing around the world, and suddenly debt has become expensive. But a number of mining companies have, because they put down the balance sheet that was at a much lower interest rate environment, that also gives them a sense of comfort. But ultimately, given how debt works and debt covenants work, if you're in a situation where you have a very, very, very stretched balance sheet, at the end of the day, those debt holders are not your friends.
Now, one company whose day of reckoning is perhaps fast approaching is Nevada gold developer i-80 Gold, which announced a restructuring plan this week for a slimmed-down company targeting the construction of 5 gold mines capable of producing an aggregate of 400,000 to 500,000 ounces a year of gold through the remainder of the decade. The appointment of Richard Young as chief executive in September was the catalyst for strategic review of the company, which has great potential, but that has been hemorrhaging money and serially underachieved under former CEO Ewan Downey. The plan includes the development of 3 underground mines and accelerating permitting and development of 2 open pit oxide deposits. And of course, a restructure and recapitalization of the balance sheet, which has $177 million of debt. Investors seemed unimpressed with the news and showed some serious road rage as i-80 shares sold down 58% on the news. Nicole, bearing in mind that we're a 30-minute show, what went wrong at i-80?
It was a bad business model. I think you speak to people who understand mining and who understand the industry. When i-80 first came out with its plans, it looks great on paper. But if you understand mining, so dealing with multiple ore bodies, underground, complex management of that, and then with an autoclave that is essentially older technology, it needed to be refurbed. So there was an underestimation by a lot of the investors that supported the name of what the cost profile would look like and the difficulty in actually managing the business. Now, if this is again a perfect example of leading indicators of things going horribly wrong. So it's absolutely not a surprise, in my opinion. I don't just think a change of CEO is going to magically fix it. These are very, very tough asset base. So it's in a very weakened position. It's in a position nobody wants to be in, as being in a negative, burning through a material amount of cash quarter on quarter. And if you just go back and look at the balance sheet numbers for each quarter, that's very, very clearly evident.
Now, part of I-80's plan was predicated on the development of the Lone Tree autoclave, which you mentioned, Nicole. This now seems to be going onto the back burner. And in any case, doesn't Nevada Gold Mines have enough spare autoclave capacity for anybody that could want to use it?
It does, but obviously if you're using another company's autoclave, it's essentially a toll milling arrangement, and so there's a material cost that's associated with that. So it makes a lot of sense, that approach. The original business model, I think, was fraught with risk, but that it had a lot of support and had a very, very hefty valuation. And the same with all of these companies. The trend is your friend. You just need to start actually. Ironically, there's a lot of information that's publicly available, but you find very few people actually take the time to sift and read through all of this information that is telling you the story that's in the financial statements and the MD&A.
Now, we're a week away from the US presidential election. It happened last week. We can't go by without talking about some of US President-elect Donald Trump's appointments. He's chosen Elon Musk to lead his new government efficiency department to, quote, pave the way for my administration to dismantle government bureaucracy, slash excess regulations, cut wasteful expenditures, and restructure federal agencies. Musk said he will post anything they do online for full transparency. Plus, he plans to run a leaderboard of the craziest ways taxpayer money is being wasted. Nicole, it seems the Don is serious about draining the swamp this time.
Absolutely. Look, I think it's positive for mining, and I would love to see in the province that I live in, which is British Columbia, which has just recently had an election and re-elected the NDP, and I think they're a fairly good example of inefficiency in government. You've seen a massive expansion in bureaucracy, whether it's in the healthcare system, which unfortunately I've experienced, that's the BC healthcare system, in governments, in academic institutions, this regulatory class blowout, and all that does is slow down the system. So I think understanding and recognising that, and then making an overt statement that we're going to deal with it. I see, no matter what you may think of Trump or the Republicans or Elon Musk, I think it's something that would behoove every single government in the world to be looking at. So I think it's great. And if they can start to reduce the regulatory burden and the decision-making process in the States, it'll be very, very advantageous for mining. But the issue with the US, it's not just the regulatory side. It takes 9 months to get drill permits in certain states like Nevada. Nevada's a mining-friendly state. That's insane. So, and the amount of working capital that you have to engender to even get to the point where you're possibly providing information that might move your underlying share price. So it's not just the regulatory framework that slows down and cements up the system. It's also the torque framework. So even if you do have a permit, a mining permit, for example, in the States, you can be held in this litigation quagmire with independently funded NGOs and environmental groups that are litigating against the government. So I'd argue that it's not just bureaucratic, it's also tort law reform.
Well, that will be a bit more difficult to address, I believe. Another bog Trump wants to address, which one you mentioned, Nicole, and that is permitting. He chose former New York Congressman Lee Zeldin as the new lead for the Environmental Protection Agency, with a mission to, quote, ensure fair and swift deregulatory decisions that will be enacted in a way to unleash the power of American businesses, while at the same time maintaining the highest environmental standards, including the cleanest air and water on the planet. I spared our viewers my Trump impersonation there. Nicole, what could swift deregulatory decisions look like under Zeldin?
I think one example is to look at what has happened under Joe Biden and the Democratic government, and that is the removal of the permits for Antofagasta's Twin Hills project in Minnesota. So that was a government level decision. to stop the advancement of that project. I think, and I think having Trump in power, for example, and the Republican approach to development and growth, you won't have some of that government overreach that we've seen. So if you just have an ideological change will facilitate change in and of itself. Because if you were as someone under the Democrat government, you will not get penalised for being negative about, I would argue, growth, particularly in mining. And what you see in the mining complex is politicians do not lose their jobs for being negative on mining, nor do regulators. And that's because they don't understand where their stuff comes from. So the fact that the US government under the Democrats has come out and said, look, we have a critical minerals list in our move towards net zero, we'd like to incentivise investment and have control over our natural resources, ensure that we have got resource security. They've said that on the one hand, and they've acted in contravention on that in the other. So I think what you'll see under the Republicans is the resource security focus, but also seeing actions that will facilitate ensuring that you have resource security.
Now, another couple of projects in the US that have had the fallen foul of the sort of broader Biden political move with Trilogy Metals, with their Arctic project in Alaska. Their shares doubled on Trump's election last week, and Northern Dynasty in the Pebble project. They've both been victims, if you like, of the Biden administration saying no without going through due process. Broader than that, Nicole, how realistic is it for more companies to get their permits quicker under Trump 2.0?
Well, we'll have to see. There'll definitely be push from the top, but at the end of the day, a lot of the political decision makers don't necessarily understand the nitty-gritty of the regulatory framework. So I think that there will definitely be a push in the right direction. How the civil servants can then, who often I think have an ideological bent that's not necessarily pro-mining development, how they can kind of clog up the system. So I think it will come down to the government ensuring that there's incentives in place for the people that are actually doing the legwork and making the decisions, ensuring that they have enough skilled people, and ensuring that there's incentives in place to push the regulators to make decisions more quickly, because that's what you see happens is if you're not penalised, if your job isn't at risk for you slowing down or gumming up the system, then it allows for people to indulge in certain ideological leanings that I think have unhealthily percolated through many aspects of society.
Okay, we have more to come, but first a word about our sponsor, Revival Gold.
Revival Gold, ticker RVG on the TSXV and RVLGF on the OTCQX market, is one of the largest pure gold mine developers in the United States. The company is advancing engineering and economic studies on the Merkur Gold Project in Utah and mine permitting preparations and ongoing exploration at the Bear Track Arnett Gold Project located in Idaho. The company is financed and currently focused on the completion of a preliminary economic study on heap leach gold resources at Merkur and continued exploration along 5 kilometers of underexplored structure at the company's multi-million-ounce orogenic gold system at Bear Track Arnett. For more information, please visit www.revival-gold.com.
South32 is to take a 19.9% stake in American Eagle Gold, which has the NAC copper gold porphyry project in British Columbia, Canada, by investing 29.16 million Canadian. South32's investment follows that of Teck Resources, which took a 15% stake in the junior in May 2023, which it subsequently increased to about 20% in August 2023 and is now currently 15.2%. Teck has the right to maintain its pro rata interest in the junior. Upon closing, American Eagle will have about $37 million in cash, enabling it to drill test its exploration hypothesis for NAC throughout 2025, 2026, and 2027. And of course, this follows Agnico Eagle Mines' recent $40 million investment for a 13% stake in ATEX Resources, which has a copper exploration project in Chile. Nicole, why are big companies dropping big money in copper explorers?
Because big companies don't have an extended growth pipeline, and they're probably waking up to the fact that we are structurally on the copper side moving into a supply side deficit, and the only way to grow your business rapidly is, and the growth pipeline is through M&A. I'm just going to step back and say a couple of things about that transaction in particular. Well done to American Gold. They did a hard dollar financing, which is important for those that understand the difference between flow through and hard dollar at a premium. They've done a wonderful job of shoring up the balance sheet of their business. So well done to them. From the perspective of South 32, I do not understand why they made that investment. Porphyries in BC, the BC regulatory environment has been getting more and more and more difficult. In fact, you've seen a trend of a decline in exploration expenditure in the province because the government, which has just been re-elected, is absolutely not friendly to mining. So there's been these regulatory changes that make it very, very, very difficult. And just one anecdotal example is helicopter firms that are transporting both drilling equipment and people over First Nations land, and now being asked by First Nation groups for compensation for that. And so the NDP government is kind of stepping away from these potential interactions between First Nations groups and mining entities, and we could spend a whole session of digging deeper talking about that. So I don't understand why South 32 did this. BC porphyries tend to be low grade. They will never be built in the current commodity price environment. Yes, price resolves everything, but they are infrastructurally challenged. They are not blessed with grade. You don't tend to have the enrichment, sufficient enrichment. I don't really understand why they did that. But stepping back, it's great to see money coming into the explorers. The explorers have been very unloved, and you've seen this on the gold side, despite having all-time record prices in gold, is explorers and developers, which to me indicates that we're not in a crazy bull market. Explorer and developers have been trading at relatively low valuations. But what we see with the ATAXs of this world and with certain deposits, it's the same thing why retail investors love them. When you have a drill bit success, when the upside is unknown, everybody assumes the upside is limitless. And the minute you become real, the minute that you put a resource estimate around your deposit and start going down that development pipeline, you become less loved. So I would argue that larger companies, to some degree, are as guilty of assuming infinite upside as are some retail investors. So
I suppose now you've got the reference point of being the next Philo.
Well, exactly. I mean, everybody wants to be the next Philo, and you do see themes of behaviours in majors. So BHP obviously took a big step with Philo, awesome discovery. The Lundin group of companies have done an incredible job of creating value through the build bit. But I mean, I would argue that they developed kind of at that perfect time from a company's perspective, their investment, which is we don't know what the upside is. The market is assuming that it's limitless. Normally what happens is the initial resource estimates, etc., disappoint. And those projects, NGX is the same, again, fantastic discoveries, but very, very infrastructurally challenged because they're at 4,000 to 4,500 metres. So their developability, they're very, very long duration assets if you're thinking about them to eventually become producers. And it's the same for the BC porphyries.
And one of the things I liked about the American Eagle Gold, the NAC financing there, was having 3 years of budget. And I want to get into, Nicole, about how important that is, because exploring for big copper projects obviously takes a lot of money, it needs a lot of drill holes. And in the poor financial markets, companies are raising a year's money. They can't really do meaningful exploration. So with these investments from South 32, from Agnico Eagle Mines, ATEX and American Eagle, they can actually stop worrying about raising money for a couple of years at least and just focus on the geology, focus on putting together their plan, their model, and proving it up?
Yeah, ideally, if you're a junior, ideally you would have enough of a runway on your balance sheet to last 3 years. In my opinion, that's the perfect number, and that's not just kind of dipping your toe in exploration. That's a material exploration program that will allow you to conduct your exploration strategy in the most sensible way. So because share prices react to drill bit information, they don't react to smart exploration in terms of with the longevity that takes. So doing geophysics and mapping and soil sampling, being very, very rigorous in terms of how you approach drilling. It's the highest cost part of the business. So companies by the nature of the beast, and this is why personally I think that big companies are ultimately going to have to take up the mantle of exploration, because junior companies, unless you have a discovery, you will cease to exist. You might be doing fantastic exploration that is providing the foundations for discovery in 3, 4, 5 years, but if you don't have that drill bit success, you're unable to raise money. So I think it's very smart of the company to remove that near-term financing pressure. And what happens is when the market sees that you don't need to raise money in the next 3 years, it means when you have positive information, you tend to have more unfettered share price performance. Whereas if they think there's a financing coming in 6 months, they'll go, well, why would I buy the shares now? I can buy them cheaper in a financing event.
Well, I fully take on board your point, Nicole, and I agree with you, which leads me to sort of the next point. In a bad market, you've got to take what money's available, and that may only be a year's money. But a number of CEOs seem pathologically phobic about dilution of their shares and their share structure, and leave money on the table. They purposefully go out just to get 1 year's money, which creates that situation where everybody knows they've got to come back, and their stock's never going to grow and thrive and prosper, perhaps because of that. Why do so many CEOs have that short-termism view on dilution rather than, okay, let's get 2 or 3 years money and immunize ourselves to a certain extent for the market for a period of time?
Well, because they don't understand capital markets. It's as simple as that. And there's this idea when you own something, it's an ownership bias. Every company thinks that they are more highly valued, that they're worth more than what they are today. Every single company. So it's a bell curve. Obviously, not every single company can be undervalued. And instead of looking at the downside, they're just sort of it's an ill-educated lack of understanding of capital markets. And frankly speaking, it's just dumb. When the ducks are quacking, when people are offering you money, you take it. You take as much as you possibly can, because whatever your share price is today, you need to have the imagination that it can go down another 80, 90% from that. So as cheap as you might be today, you can get a hell of a lot cheaper. And I can point to numerous examples in particularly this happens in bull markets, at the top of bull markets, of a CEO that had an African developer, and this happened last cycle. He was offered 600 million in cash, said no. He went out, he was acquired in the bear market for 50 million.
Wow. It does seem that sometimes CEOs have too much skin in the game and perhaps too aligned, and then they therefore make decisions more in line with the impact on their own personal wealth rather than the best interest of the company and the overall group.
Yeah, I agree. I think there's probably a perfect level of ownership. And so having CEOs that have very material control positions, not always, but sometimes it becomes very much of a focus is that I am getting diluted. So instead of stepping back and going, this action that we would take today will positively impact every single shareholder. And yes, I might own a little bit less of the company, but my investment may go up materially because I've removed all future financing pressure for the next 2 to 3 to 4 years, whatever. I mean, the longer your runway is, this is a high-risk business. It's very, very difficult to predict timelines. You see enormous volatility. You can have markets turn from being lots of capital available to zero being available. So you have to manage your business always assuming the worst. And to have the hubris of thinking that you always know better, I think that's dangerous.
That's very dangerous. Okay, let's end on a real positive note. Troilus Gold received a letter of intent from a German export credit agency for a $500 million loan guaranteed to help fund the $1.1 billion development cost of its Troilus copper gold project or gold copper project in Quebec in Canada. Troilus said the copper component is proving critical for attracting interest. The company aims to submit an environmental and social impact assessment in January. It could be fully permitted by the end of 2025 as it seeks to build an open pit operation to produce over 300,000 ounces a year of gold equivalent for 22 years. Nicole, how important is it for gold projects to have that copper component, that copper kicker, to get interest?
I think it opens up for a wider range of interests, and in that particular deal terms, it was predicated, and they haven't given the exact nature, but the concentrate is part thereof. I don't know exactly much, I couldn't see it in the press release, is going to a German owned smelting company, Arubis.
Yeah.
So this was part and parcel, and I think what Germany and Arubis is doing is we live in this world because we're seeing this decline in supply, primary supply, but we're seeing a very material decline in concentrate availability. And that's why you are seeing this really dramatic decline in TCRCs, so treatment charges and refining costs. So they went negative for a point. That was short covering, but they went negative for a point early this year. And so I think the very smart firms are looking at this future where we need to secure supply. And we're taking a view on ensuring that we have, and this is where governments get it wrong too, is they say, well, we want to build more copper mines in our country, but copper mines, most of copper production is concentrate. And guess who has most of the smelters in the world? It's China, with over 55% of smelting production. So for Germany, because it's securing primary supply, but it's also securing supply for its smelters. So it's kind of two great needs meeting. And it's easier to attract that kind of capital, particularly with the green thematic, than it is just to be a gold developer. So that was kind of a unique transaction, and well done to Justin and the team.
It does seem that gold developers are having to shake the can far and wide to get finance. It does seem to a certain extent the traditional sources of finance are less available today.
Absolutely. I mean, you've seen that the traditional banks, I mean, when was the last time you saw a traditional bank involved in financing? And that gap has been filled by the Orions of this world, which are the Orions and also the royalty streaming providers. So you are seeing mines getting built, but I would say with the developers, I think where we're moving into the part of the cycle, because most mid-tiers and junior gold miners are looking for growth. They're looking to expand. And at the moment, that focus is on operating assets, but they will start to move down the food chain. So I think you'll start to see a number of these developers that will get acquired, as long as they don't permanently impugn the valuation of their asset with a stream or a royalty or some sort of financing mechanism which destroys value at the asset level. So I think what you'll see is the larger companies will start being the suppliers of capitals for building new production.
Well, let's hope so. Nicole, it's been great. Thank you very much for joining us once again.
Thank you very much for having me, Paul.
And of course, to our viewers, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.